Well, we got some jobs data in the U.S. today, which did indicate folks on Wall Street that we're seeing a slowdown for the U.S. economy. And all of a sudden, in a week that started out with expectations that you might not see interest rate cuts in the U.S. this year, heck, some people wondered if you'd see interest rates actually have to go up again because of inflation worries. Jay Powell, the head of the Fed, seemed to push back on that idea today. And now you've got investors, because of a weakening jobs report, pushing back on the idea that we won't see rate cuts this year in the U.S. Confused yet? Well, the market has to certainly try to make sense of it. Alec Young does his best as well. He's Chief Investment Strategist at MapSignals, and he joins us with a little bit more on the moving parts of the markets. I guess, Alec, you know, are we back in a situation where bad news is good news for the market? What's your interpretation this morning?
Sure. Good morning, John. Thanks for having me. There is an element of bad news is good news. We got 175,000 jobs, about 50,000 less than expected, which was perfect. There have been concerns that the economy was too strong to allow the Fed to cut rates. And then on the inflation side, wage growth came in at 3.9% year over year, below the 4% expected, and the lowest since inflation peaked a couple of years ago. So it was really a Goldilocks report. And that, you know, sent bond yields plummeting. I think we're below 4.5% on the 10-year. We had gotten up to 470 in the last couple of weeks. And as you said, people were really betting that we might not get any cuts this year. We might even get a hike. Chairman Powell took the hike off the table at the Fed meeting on Wednesday in his press conference. But there was still a lot of lingering uncertainty around higher for longer and how long we'd have to wait for the next rate cut. And now futures are pricing in solid chance of the first cut in September. So it's a much more bullish backdrop, especially for interest rate sensitive areas like small caps, real estate investment trusts. These are areas that have really underperformed because of the drag of higher rates. So, you know, this has been extremely bullish for the whole market, but especially these very interest rate sensitive sectors.
And Alec, you've never really sounded too concerned about the worrisome headlines that we kind of digest over the last year or so. And that's proven to be the right call, because you look at the chart of the S&P 500, and when you stretch it out, it's basically up, up, and away. But I guess the fact that we had gone so far so fast had also invited the question, well, do the headlines actually have to be that worrying to see a pullback? Aren't pullbacks healthy? So how do you feel about where the market is today and where it could be over the next few months?
Sure. Well, we definitely had, I think we had a 28% rally in the S&P 500 from the lows in late October through the end of the first quarter. So, I mean, that was just a top percentile move for, 6 months. It was one of the best of all time. So generally, when that happens, you give back at least 10% in a healthy corrective process. This time, we only gave back 6%. And given the macro news that we're getting, earnings are generally beating expectations. There's really no reason to think it's going to be any worse than that, at least not in the near term. So we were overbought. We needed to consolidate and digest the gains, and we did that. You know, the market had a rougher time in April, but we're through that now. A lot of the macro concerns that drove that profit taking have proven to be unfounded. The macro is improving. Fundamentals with earnings are improving. 12-month forward earnings on the S&P are now something like $252 a share. They were in the 246, 247 area about a month ago. So profitability continues to improve. U.S. stocks aren't cheap. We're a little over 20 times 12-month forward earnings. So that is a bit of a constraint, but that doesn't really drive the trend. It just means that the pace of the upside through year end and the amount of chop in the market, we're probably looking at, a good year, but not a great year like last year, where we saw 26% with dividends in the S&P. This feels more like a 10 to 15% year, but I think most investors would definitely take that. So I think the market is on much healthier footing after the profit taking that we've seen in April than it was at the end of the first quarter.
Now, before I let you go, you talked about what this development and I guess sort of fresh expectations around rates means for, let's say, small cap stocks, sort of the interest rate sensitive stocks. Tech, I think everybody has a different opinion on how rate sensitive they are, or if they're just kind of in a class of their own in terms of like their businesses are growing and they don't have to worry too much about this stuff on the margins. But investors have worried. And then you have this story today of Apple shares that are outperforming. They're able to, even if there are concerns about overall demand for iPhones these days, use their capital base to appease shareholders, record stock buyback. How do you feel about the story of tech going forward?
Well, our work, we track institutional money flow at MapSignals, and we're seeing bigger buying in energy, materials, industrials, financials. But tech, you can't ignore tech. It's where most of the earnings growth for the U.S. stock market is coming from. These companies have a ton of cash. As you know, you cited the record buyback from Apple, so they aren't as rate sensitive. They don't have to borrow money. It doesn't mean that if rates shoot up to 5% very quickly, that isn't going to impact big tech's valuation. But generally speaking, as long as the profits continue to roll in, other smaller sectors may outperform tech temporarily, but tech is always a solid long-term investment in the U.S. Right now, we think there's a little bit more tactical opportunity in some of the other sectors that I mentioned, but we're by no means negative on tech. If you get negative on tech, you're essentially getting negative on the U.S. stock market because big tech stocks represent about a third of the S&P 500 index.